Hello and Happy New Year. I hope 2026 is off to a healthy and positive start for you all. I'm Tim Lincoln, Managing Director of Stock Doctor, now part of the Prime Financial Group, and joining me today is Kien Trinh to stream you all things share market. Happy New Year to you too, Kien.
Thanks, Tim. It's great to be back, and it's great to see the markets continue to do quite well, especially while we were away. But yeah, these periods they fly, don't they, during the holiday break?
They sure do, but plenty to talk about the markets in a moment. But before we get started, Kien, just a quick reminder to everyone that all the information we share today is of a general nature and shouldn't be construed as personal advice. And all of the data and performance metrics that we share are all historical in nature and therefore shouldn't be relied upon as a guide for future performance. As you mentioned, Kien, the markets have started 2026 on a really positive note, despite plenty of macro noise, including tariff tensions, ongoing US-China trade risks, political uncertainty in Iran, and shifting interest rate expectations. Those uncertainties have helped push gold higher, which has also supported our star growth stocks quite considerably, given the portfolio's strong exposure to gold. But with the first half of 2026 reporting season approaching, Kien, the key is to block out that macroeconomic headline and focus on bottom-up stock picking and quality fundamentals in stocks like our star stocks. So, Kien, how are companies tracking at the moment, and what's the outlook for the earnings growth for the market going forward?
Yeah, Tim. Fundamentals generally quite solid. Investors are still quite bullish. Earnings revisions has improved over the last few months, Tim, and that's been driven by a lot by, you mentioned it, in gold, also lithium and copper, while banks have held up because doubtful debts and unemployment rates are quite low. And you can see that on the chart on screen, comparing the All Ords index, that's in purple, with earnings expectations in blue. And looking ahead, you can see that forecasts remain quite constructive. The market is expecting to deliver around 6% earnings growth, with resources doing most of the heavy lifting at roughly 13%. And no surprise there, it's gold that's really driving that.
And our star stocks look really strong too, Kien, with expected earnings growth of over 16%. That's a real indication of the quality universe that the star stocks reside in. But reporting season is where portfolio discipline really matters. It's less about predicting results and more about managing risk. Review your holdings, reduce exposure to financially unhealthy stocks, and staying diversified across at least 15 stocks in quality names within your portfolio is really, really important.
Yeah, because reporting season can be quite volatile at the stock specific level, but it also pays to keep some cash available to take advantage of any oversold opportunities, Tim. And profit taking is key, especially across stocks that have rallied too hard and too fast, such as those in the mining sector more recently.
Yeah, exactly, Kien. And the mining sector is a sector that's really run hard, hasn't it? And we can start to see some value now really appearing in especially healthcare and technology. So keep an eye on those shifting cycles. But yeah, materials, especially gold's been doing all the heavy lifting of late. And but it is so important in order to focus on those stocks, those quality stocks, and roll with those rotations, is to block out that macroeconomic noise. And speaking of star stocks and those in the gold sector, let's flick our focus now to some of the platform providers, which all release quarterly updates this Kien. What are your thoughts and observation on those updates?
Yeah, very interesting, Tim. I'm in HUB24. They deliver the strongest update with platform net inflows ahead of expectations. And Hub now is ranked number one for inflows for the eighth straight quarter. And they also may benefit from this disruption following the First Guardian collapse too, Tim.
Hmm. Yeah, Netwealth has underperformed, Kien, but the underlying numbers still look really strong. Earnings revisions are stable and return on equity is expected to remain above 60%. So therefore, Kien, with the latest bout of share price volatility amongst these platform providers, does it represent an opportunity for Netwealth?
Yeah, very interesting with Netwealth. They are exposed to that First Guardian collapse, and
Mm.
that's why the share price has weakened over the last couple of months. But for long-term investors, potentially they represent the opportunity. The compensation cost to them is around 100 million, but there may be additional compliance costs and also reputational impacts, which will take some time to play out. Meanwhile, their margin outlook was slightly softer than expected, and that reflects ongoing investment, Tim, but they are trading at quite a large discount to fair value. So investors will need to be patient with this one.
Yeah, big lesson for them, isn't it? And I'm sure they'll be upping their due diligence standards when considering admitting, funds onto their platform going forward.
Mm.
But those who are trend sensitive should wait on the sidelines with Netwealth, given the stock has triggered an exit on SD30 TSR and SD Max. Those two indicators, technical indicators, if you're trend sensitive, work brilliantly as part of a strategy. I also like the fact that the founders and leaders of the business, both father and son, Michael and Matthew Hayne, remain large shareholders in the business. So plenty of skin in the game. We love to see that. And also, Kian, let's have a bit of a look at Praemium. So its shares were quite volatile following its update also.
Yeah, that's right, Tim. Praemium, the smaller of the three, they are going through a transition phase as they absorb recent acquisitions and also deal with migration from legacy systems as well. So there is a level of shareholder pessimism with the stock, but overall, the update was solid. Platform funds under administration and inflows were ahead of market expectations. So we view the share price discount here as as an opportunity as well.
And now to Under the Microscope, Kian. And this week, we're not focusing on a specific company, more of a theme. And with the reporting season just around the corner, let's turn to a theme that's hard to ignore. And even with interest rates coming down over the past 12 months or so, it's been a really tough period for retailers, which they normally prosper in a lower interest rate environment. Sales might hold up, but profits are being squeezed by heavier discounting, patchy demand, and rising costs. And we've already seen downgrades across the sector early this year.
Yeah, and to monitor this, you can check those earnings revisions as we're heading into reporting season just to assess your risks and exposures. But a good example here is auto and outdoor retailer Super Retail Group. They delivered record first half sales, but their profits, it fell short of expectations as promotions picked up, especially at Rebel Sport, where margins came under pressure. And management, they did say that Rebel's like-for-like growth was credible, but the reality is it's getting more expensive to stay competitive with store openings and also closures and refurbishments, all adding to the cost. And the result was a profit guidance well below expectations.
And that's why diversification really matters, doesn't it, Kian? Diversified portfolio of at least 15 stocks is
Mm.
really important. And why we prefer businesses with profit margins above 5%. So they got that nice margin of safety there in regard to margins. Revenue growth is great, but if you're discounting to defend market share, earnings can still go backwards very, very quickly.
Yeah, that's right, Tim. And we saw a similar story with ARB Corp, but for
Yeah.
different reasons. Sales actually softened, and that was due to the timing of model releases and also fitting capacity constraints in Australia, although the US export channel remains a bright spot for ARB.
Yeah, and NARB's another good example of stock that's triggered SD30 TSRKN. So trend-sensitive investors should be out of the stock and waiting for a re-entry point to appear, which would be 30% above its latest low. And let's have a bit of a look at A2 Milk as well, Kian. It only upgraded guidance back in November, but what's changed?
Yeah, the markets, how quickly things can change them,
Oh,
especially
wow.
with infant formula producer A2 Milk. They show how demand can be hit by structural headwinds as well. And the stock was sold down quite sharply after China's latest birth data confirmed another decline in newborns. And
Yeah.
that does raise fresh concerns about long-term infant formula demand, especially around those risks.
Yeah, but Jason Yin's totally across A2, and It's a stat that's come out, heavy price fall, but probably representing opportunity in a quality stock, so long as they deliver on their financials based on the upcoming reporting season. So FY26 could still be a flatter year for growth, and we'll watch closely how this flows through earnings revisions and return on equity forecast, Kien. And now to question of the week, Kien. With so many high growth stocks, especially in the tech and healthcare sector, having fallen significantly on the back of rising interest rate expectations, a useful question for investors leading into the reporting season is, how can I find some oversold opportunities, Kien, within Stock Doctor?
Well, Tim, the easiest way to do this is to refer to our watch list. Here you can select the predefined star growth or star income stock list. Then you can sort the stocks on total return metrics, such as a 12-month price change or SD30 TSR. Then refer to the 3-month earnings revisions field. That's just to ensure that the earnings trend has been stable and that there is a clear divergence between price and fundamentals here.
Excellent, Kien. And from a growth perspective, when you're trying to find those oversold growth opportunities, some really attractive names are coming through, including CSL, Pro Medicus, REA, Aristocrat Leisure, Breville, Jumbo, Steadfast, Cochlear, Netwealth, Technology One, Objective, Lavisa, and Bravura Solutions, to name a few. Most of these stocks are trading 30% below their highs based on 30 TSR, some even around 50%. So high quality businesses that are based on the cycle of, we believe, being oversold and are representing opportunity. But leading into reporting season, we just got to be careful around timing as to how much we invest in these stocks should their fundamentals change on their reports.
That's right, Tim. And the earnings revisions for many of these are holding up still very strongly as they head into reporting season. So yeah, keep them on your watch list. And from an income perspective as well, opportunities exist across Spark New Zealand, some of the banks, Bendigo Bank's been sold down quite heavily, Suncorp, Jumbo Interactive as well, JB Hi-Fi, Steadfast, and also Integral Diagnostics as well, that medical imaging company.
Yeah, and obviously with those declining prices, the dividend yields start to look even more attractive. So from an income perspective, so good stuff. Yeah, love to find opportunities, and there certainly are some presenting themselves amongst the Star Stock universe, which is great. You can also find the opportunities not only in the watch list but in the stock filter. But we'll leave that for another episode. But in the meantime, jump into my growth and income stocks with potential filters, and just have a bit of a forage around in there to see if there's any opportunities that you like. And with reporting season around the corner, it's best to keep these stocks on your watch list. And as I touched on a moment ago, wait for the results to confirm their fundamental quality. Also ensure you read the analyst commentary, because we're really trying to say in the commentary, especially in the strategic comment, who does the stock suit and what should you be doing with it now, and also commenting on all of the rules. All right. And yeah, many of the stocks that are in our universe, we also articulate those active risks that we may act on from time to time. All right. Good stuff, Kien. Great sitting down with you again. I hope our members enjoyed this episode. But yeah, thanks for your insights as always.
A pleasure, Tim, and look forward to the next couple of weeks with a very, very busy reporting season.
Yeah, we're doing a lot of testing internally now on new models and improving our quantitative methods and whatnot. So some really exciting results coming through. Can't wait to share that with our members over the course of 2026 and probably fairly soon as well. So some really exciting developments going on in Stock Doctor. And don't forget, because of that, we know most of our members love Stock Doctor, high dependency on it to make informed and confident investment decisions. Don't forget to tell your family and friends. We love organic word of mouth referrals, or if you've got the name and details of someone who you know would really benefit, just flick them through on an email. We'd really appreciate it. It's how we grow. All right, until next week, have a happy, healthy, and prosperous week. Goodbye for now.